Picture this. You're sitting at the dealership, the salesperson slides a piece of paper across the desk, and there it is in big friendly numbers, $310 a month. And your brain goes, oh, that's not bad. That's the moment the whole game is won or lost, because they just got you thinking about a payment instead of a price. Today we're settling the oldest argument in car buying. Should you lease or should you buy? I'm going to give you the honest version, the one with the math the dealer would rather skip, plus the moments where each option is secretly the smart move. If this saves you even one bad decision, do me a favor, hit subscribe and share this with anyone you know who's about to walk into a showroom. Trust me, future them will be grateful. Let's get into it. Here's the thing nobody explains clearly. When you lease a car, you are not paying for the car. You're paying for the chunk of value the car loses while you're driving it. That's it. If a car is worth $35,000 new and the bank figures it'll be worth $22,000 in 3 years, you're essentially paying for that $13,000 drop plus interest and fees spread across your monthly payments. At the end, you hand the keys back and walk away. So a lease is really a long, fancy rental, which isn't automatically bad. It's just important you know that's what you signed up for instead of thinking you're slowly buying something. Spoiler, you're not. You're borrowing it with really nice floor mats. Buying is the opposite philosophy. Whether you pay cash or finance it, you're purchasing the entire car, all $35,000 of it, and every payment chips away at a loan until one glorious day it's yours free and clear. And here's the part people underestimate. That paid-off car still has value. It becomes an asset you can sell, trade, or just keep driving for years with zero monthly payment. The trade-off is that buying usually costs more per month up front because you're financing the whole vehicle, not just the slice that depreciates, but you're building equity instead of building a stack of receipts. Think of leasing like renting an apartment and buying like owning a house. Both are valid, but only one of them you eventually get to stop paying for. Now let's talk about the single most expensive mistake people make, and it applies to both leasing and buying: shopping by the monthly payment. Dealers love a payment shopper the way a cat loves a cardboard box, because if all you care about is hitting $350 a month, they have a dozen ways to get you there. Stretch the loan to 72 or 84 months, roll in fees, bump the interest rate, quietly raise the price. You feel like you won, and meanwhile the total cost ballooned by thousands. The pro move is to negotiate the actual selling price of the car first, as a number, before anyone whispers the word monthly. Lock the price, then talk financing. If a salesperson keeps dragging you back to the payment, that's not a coincidence. That's the strategy. If you lease, you need to know one weird little number called the money factor, because it's the lease world's sneaky way of hiding the interest rate. It shows up as something tiny, like 0.00125, which looks harmless, almost cute. But here's the magic trick. Multiply that number by 2,400, and you get the actual interest rate as a percentage. So 0.00125 times 2,400 is 3%. Now you can compare it to a real loan rate and see if you're being treated fairly. Most people never do this math, which is exactly why it's buried in a format you can't read at a glance. Do the multiplication right there at the desk. Watching a salesperson realize you know the trick is honestly one of life's small pleasures. The hero of any lease, the number that quietly decides everything, is the residual value. That's the bank's prediction of what the car will be worth when your lease ends. And here's the beautiful logic. The higher the residual, the less value the car lost, which means the less you have to pay. So two cars with the exact same sticker price can have wildly different lease payments purely because one holds its value better. This is why leasing a brand that depreciates like a dropped phone can be brutal, while leasing a model with a strong residual can be a genuinely great deal. So when you lease, you actually want to lease the cars that are good at keeping their value, which feels backwards until you remember you're only paying for the part that disappears. Every lease comes with a mileage limit, and this is where a lot of dreams go to die. Most leases give you somewhere between 10 and 12,000 miles a year, and if you go over, you pay a penalty per mile at the end, often 15 to 30 cents each. That sounds small until you do 5,000 extra miles and get handed a bill for $1,000 as you're trying to walk out the door. So before you sign, be brutally honest about your driving. Got a long commute, a big family, a habit of spontaneous road trips? A lease might fight you the whole way. You can buy extra miles up front, usually cheaper than paying at the end, but the real lesson is simple. Know your actual mileage before you agree to a lease on it. Let's talk about lease return day, because it can be a quiet ambush. When you give the car back, they inspect it, and you're on the hook for anything beyond normal wear and tear, a phrase that means whatever they decide it means. Curb rash on a wheel, a dent from a runaway shopping cart, a mystery stain from that one smoothie incident. All of it can show up as a charge. The smart move is to get the car inspected a month or two before turn-in, so you can fix the cheap stuff yourself instead of paying the dealer's premium prices. A $40 wheel repair at a local shop can save you a couple hundred at return. Treat the last few weeks of a lease like you're getting your security deposit back, because that's basically what's happening. Here's the single biggest argument for buying, and it's a good one. Eventually, the payments stop. You finance a car for, say, 5 years, and then for years afterward, you're driving the same reliable vehicle with a grand total of $0 leaving your account each month. That gap, those payment-free years, is where buyers quietly get rich compared to leasers. Because a leaser is on a treadmill. Their payment never ends. They just roll into the next lease, then the next, forever. The buyer who keeps a paid-off car for 3 or 4 extra years can bank or invest what would have been car payments. It's not flashy. You don't get that new car smell every 3 years, but your wallet will throw you a little party every single month that loan is gone. The dark cloud hanging over every new car is depreciation, and understanding who absorbs it tells you a lot. A new car can lose 20% of its value the moment you drive it off the lot, and around half its value over the first 3 years. When you lease, you're sidestepping the resale gamble. You agreed to a set residual up front, so if the market tanks, that's the bank's problem, not yours. When you buy, that depreciation is yours to own. For better or worse, if the car holds value well, you win. If it drops like a rock, you eat the loss when you sell. This is why some people lease specifically to avoid the uncertainty, and why buying a slightly used car, letting someone else take that first brutal hit, is often the smartest money move of all. Here's a counterintuitive one that'll save you real heartbreak. On a lease, you generally do not want to make a big down payment. I know it feels responsible, like you're being a grown-up, but think about what that money is doing. It's prepaying part of a car you'll never own, and here's the gut punch scenario. If that leased car gets stolen or totaled in month 2, the insurance pays off the bank, but your big down payment? Gone. Vanished. You don't get it back. With a purchase, a down payment builds equity you can recover. With a lease, it just lowers your payment a little while exposing your cash to risk. So keep the upfront money on a lease as low as you reasonably can and let the monthly payment carry the load. Speaking of cars getting wrecked, let's talk about the gap, and I don't mean the store. Early in any car loan or lease, you often owe more than the car is actually worth because cars depreciate faster than you pay them down. So if it gets totaled, your regular insurance only pays out the car's current value, which might be thousands less than what you still owe. That difference is the gap, and without protection, you're paying out of pocket for a car you can't even drive anymore, which is about the worst feeling in personal finance. Most leases include gap coverage automatically, which is a genuine perk. If you're buying and financing, ask about gap insurance, but don't let the dealer charge you triple. Your own insurer usually offers it for pocket change. All right, let's get fair, because leasing isn't a scam. It's a tool, and sometimes it's the right one. Leasing genuinely shines if you love driving a newer car every 2 or 3 years and you don't care about ownership. It works beautifully if your mileage is low and predictable, like a steady commute with no surprises. It can be a smart play for business owners who write off the expense. Talk to your accountant, not me, I'm a car guy, not the IRS. And if you want the latest safety tech and a full warranty covering basically the whole time you have the car, leasing keeps you in that worry-free zone. If that's your life, lease with confidence, just negotiate the price like you're buying it. And on the other side, buying is the clear winner more often than the dealership would like to admit. If you're the type to keep a car until the wheels practically fall off, buying wins by a mile. Those payment-free years are pure savings. If you drive a lot of miles, buying frees you from the mileage leash entirely. Drive it to the moon, nobody charges you a dime. If you want an asset at the end instead of a stack of canceled checks, you buy. And honestly, for most regular folks who just want a dependable car and the lowest total cost over 10 years, buying, especially buying a gently used car, is the quiet, boring, deeply correct answer. Boring is underrated when boring means thousands of dollars in your pocket. Here's a secret that the lease world really doesn't advertise. You can negotiate a lease, and you absolutely should. People think a lease payment is fixed, like a phone bill, but that monthly number is built on the selling price of the car, what's called the capitalized cost. And that price is just as negotiable as if you were buying it outright. Knock the price down, and the payment drops right along with it. So walk in, negotiate the purchase price first like a buyer, get that number as low as you can, and only then mention you're thinking about leasing. If you announce, "I want to lease," on minute one, you've handed them the keys to the whole negotiation. Make them earn it. Quietly nail the price, then talk lease. So let's bring it home. Leasing means renting the depreciation, lower payments, a new car often, but a payment that never truly ends, and a mileage leash to respect. Buying means owning the whole thing, higher payments now, but glorious payment-free years and a real asset at the end. Neither one is automatically smarter. The smartest choice is the one that matches how you actually live and drive. But no matter which road you take, the golden rule never changes. Negotiate the price of the car first, before anyone hypnotizes you with a monthly number. Do that, and you've already beaten 90% of the people on that showroom floor. If this helped clear things up, hit subscribe so you catch the next one, and share it with someone about to sign for a car. Whoa, that's how we keep folks from getting fleeced. I'll see you in the next video.